Negative amortization caused so many problems in 2008 that many countries in the EU banned it. But Canada is embracing this as the solution to a mortgage default crisis, which is going to happen and is inevitable. So let's get right into this EU paper that basically talks about negative amortization. And you guys are not going to believe the parallels between Canada and what's happened in 2008 and what the EU did. So the most evident problem is called negative amortization, also known as NegAm. This problem occurs when early cash flow payments are so low that they are less than the interest charged over the period. The consequence is that the unpaid accrued interest is capitalized into the outstanding principal balance, which actually increases rather than falling with the successive payments. As the principal balance rises, the monthly interest due also increases. And this is basically what we're talking about, negative amortization. We know how many loans in Canada are in fact in negative amortization, and we're going to get into that in a second after this. But this shows the devastating impact of negative amortization, how any negative amortization loan is subprime, and how the banks just are not preparing for defaults to rein in. And it's literally exactly like 2008 in the US, where they had a lot of these NegAm loans, which we're talking about right here. So negative amortization increases default risk. If the home price declines even slightly at the beginning of the loan to value ratio climbs significantly, increasing exposure to default risk. The recent turmoil in the subprime mortgage market, they're talking about 2008 here, largely illustrates the situation where a borrower owed more on her/his property than it is worth. Borrowers being underwater had to refinance with a very high loan to value ratio, requiring additional covenants, mortgage insurance, and higher rates, which led to some of them defaulting. And we're going to get onto also how these banks, the loans are actually getting more expensive for these banks to keep. So there is a rising cost there that they're not going to hesitate to try and pass on to the consumer. So if you think the consumer is getting some kind of get out of jail free card here, they are not. I mean, think about it. These consumers who took out these loans are seeing their balance rise. They're seeing the amount of interest that they owe just go up and up and up. It's an absolute disaster waiting to happen. And you've got the regulators who are in bed with the banks, and you've got the government who's also in bed with the banks, all praising this as some kind of solution, despite all the evidence from 2008 on how bad negative amortization is. People just can't accept it. It's unbelievable. Anyway, it goes on to say, although NegAm is legally forbidden in several European countries, the current financial crisis, they're talking about 2008, initiated by the subprime crisis, put the problem forward. This had led to politicians to propose laws prescribing any NegAm practiced by commercial banks. So essentially banning it and making it illegal. And now we're going to get on to just how many of those mortgages, as the banks have recently reported their earnings, we can now see the devastating impact and risk which is held by these banks. So let's get into it. Mortgages have increased in size, a phenomenon known as negative amortization. Because of the sharp rise in interest rates, financial reports from Bank of Montreal, Toronto Dominion Bank, and Canadian Imperial Bank of Commerce show that there is basically a lot of negative amortization going on. So let's start off with BMO. They disclosed that mortgages worth $32.8 billion were negatively amortizing in the third quarter ended July 31st. That is the equivalent of 22% of the bank's Canadian residential loan book for the second quarter ended April 30th. The total was $28.4 billion, equivalent to 20% of BMO's loan book. So think about this. We are not talking about small amounts when it comes to this negative amortization. And when we keep hearing about hundreds of millions have been added to essentially be there as a buffer, so if people start defaulting, the banks can get that liquidity they need. Well, guess what? If you look at the amount of loans that are negatively amortizing right now, you don't have to be a rocket scientist to work out that even if 10% of those loans start defaulting, the bank's liquidity is just going to completely flip on its head. They're not going to have enough money to keep going. And that does not mean that the bank doesn't have enough assets on their balance sheet. It just means, what are those assets and how much are they worth? I mean, if the perceived counterparty risk is skyrocketing, skyrocketing, especially on residential mortgages because of these negative amortizations, how many other banks are going to be willing to buy those loans, especially if they're in the same situation? Canada has a banking monopoly. There's only really 5 big banks here in Canada. So that makes things even worse when you've got 3 of them essentially that are in this precarious situation. And then you've got Scotiabank that is actively tightening up the lending, and they're one of the ones that is passing on the payment increases directly to the consumer. So it's just kind of insane what is going on. It really is, guys. The size of this is just unbelievable. So TD had mortgages worth $45.7 billion negatively amortizing in the third quarter, the equivalent of 18% of its Canadian residential loan book. That was higher than the $39.6 billion or 16% of its loan book in the fourth quarter of last year. So these mortgages are increasing and increasing and increasing. And you don't have to be a rocket scientist to work out that, guess what? That means the projections of the interest that they're earning is going up, which looks good for the investors. The investors think, wow, their revenue's actually going up. They're making lots of money off the high interest rates, but they don't realize how much risk is on their balance sheet. An insane amount of risk. I mean, I cannot believe that Canada is essentially repeating what the US did in 2008, expecting a different result. I mean, that's what Albert Einstein says. Repeating the same thing and expecting a different result. It's the definition of being insane, according to Albert Einstein. And he's not wrong, because think about it. Canada is expecting a different outcome. They expect this to be a solution, believe it or not, which is crazy. And this is far from a solution when you've got the loan amount increasing this much. This is just unbelievable, guys. It really is, especially when you consider what we hear from the regulators, the government, that everything is fine, you have nothing to worry about. So kind of crazy what's happening at TD. And then in this year's third quarter, CIBC had mortgages worth $49.8 billion, the equivalent of 19% of the Canadian residential loan book in negative amortization. That was higher than the $44.2 billion or 70% of all its portfolio in the second quarter, according to its financial results. So you've got BMO, TD, and CIBC. These are the 3 banks that really are in trouble, in my opinion, with all these negative amortization loans. And who's going to buy them? If they need to fire sale these assets, look, just think it through real logically. Lots of people start defaulting on those loans. Well, guess what? CIBC and BMO and TD, they have to pass on and remit the payments to the pension funds or whoever holds that mortgage. So if they're not getting that money from the borrowers, they have to get it from somewhere else. So they have to get it from somewhere else on their balance sheet. And they're not going to have enough money to go and get it from their loan loss provisions. And that's precisely the problem. And then if they have to try and fire sale a bunch of mortgages which they do hold on their balance sheet, who's going to want to buy them? I mean, this is exactly what happened in 2008 on the back end. You just had this massive amount of risk that formed, and people were like, oh yeah, you know, everything's fine. Subprime is contained. And it's just not. I mean, what people don't understand is the risk that banks have to take in order for prices to continue and the bubble to continue going on just increases and increases and increases. Regardless of what happens with population growth and everything else, the risk in the system increases. And the thing that really pops the bubble at the end of it is 2 things. It's recession, job losses, and it's also the banks saying, we don't want to lend. You want a mortgage for an investment property? Good luck. You're going to need 50% down payment. All these conditions that people can't meet essentially because they've got their hands burnt and they don't want anybody else coming in, and especially investors, because investors are more likely to default. They are a higher risk than somebody who's going to live in the property. So there is a massive amount of risk here, which people just aren't talking about, and I think is kind of crazy. And then the OSFI, you know, we know who the OSFI is. Basically, the guy who runs the OSFI, Peter Routledge, is a bankster himself. So he served as managing director of research at National Bank, and he also was leading the Canadian Financial Institutions Group at Moody's Moody's Canada. So this guy is a bankster. Just remember who's in charge of regulating the banks. A bankster. I mean, this is exactly the type of corruption that caused the financial crisis in the US, because all the regulators were also corrupt. Guess what? They were all in this thing together. That's exactly why nothing ever happened that produced anything to essentially rein in that risk. And it's very hard to do so when it's at this stage where we're at right now. So Peter Rutledge is a bankster, and then you've got the OSFI, the Financial Post, coming in saying, oh, the OSFI is doing all these stricter capital requirements, everything's going to be fine. Canada's federal banking regulator is preparing to make banks hold more capital against certain mortgages where homeowners' payments fail to cover even the interest and the loan balance is greater than 65% of the property. So they're talking about NegAm loans there, negative amortization loans. The OSFI said such loans are riskier for banks and mortgage insurers and wants more capital to be held against them if the loan to value ratio is above 65%, meaning the outstanding balance of the loan is greater than 65% of the value of the property that is collateral for the loan. So you got to think about that. That is most of those mortgages, right? Because most of those variable rate mortgages we know were took out in 2021, 2022. So you've only got to think about it like this. The bank is now being told, okay, you need to hold more capital against these mortgages, making them less profitable. And then what does that do? It means that they don't want to lend, and they're less willing to do different things in terms of adjustments if a borrower is in distress for these mortgage types, because they're already not profitable for the bank anymore because it's eroding their margins. Now, whether you think the bank is wrong or right about doing that is a different thing, but it's just a simple case is when they actually took out most of these loans, it was very profitable for the bank. But now the OSFI is coming in and they're saying we're going to do this, that, and it's really just virtue signaling because it's not doing anything. The amount of capital that they're actually requiring them to hold is just ridiculous. And even though we keep hearing that, oh, the loan loss provisions doubled, it's still less than $1 billion. And we're talking about, $50 billion worth of loans in negative amortization in some cases. And we know that default rates peaked out around 13% in the US. We know that we're in a much worse state here in Canada than the US was in 2008. So if default rates peak out at 10%, which is a very low value, then what is going to happen? What is going to happen? Essentially, like I said, you're going to have a liquidity crisis in the Canadian financial system. And this could be what the yield curve is referring to. And we're going to go on to now another thing that is causing major problems that people fail to recognize. And it is the commercial real estate sector. The commercial real estate sector is not in a good place. And this is in the US, but the same thing is happening in Canada. And basically, Carl Bass came out and he said that banks could hemorrhage $250 billion in the US because of cratering office real estate market. Now, in Canada, it's actually worse than in the United States, just like everything is worse, unfortunately. So this report came out July 4th, 2023 from CBRE. Vacancy inches higher with anticipated new supply to largely deplete construction pipeline by year end. So when you get into this report, you can see what's going on here. You can see how you basically got new supply coming in, and you've also got the net absorption rate wildly negative apart from a few quarters. I mean, it's just been so negative. And you've got the vacancy rate, which is this green line here, that is just going up. It's still going up. So despite this quote unquote booming economy, resilient economy, as Chrystia Freeland keeps saying, you've got office vacancy rates going up. That doesn't make sense, does it? Because surely we've gone away from the work from home in a sense right now. So people aren't increasing the amount that they're working from home. It's actually the opposite that is happening. So surely those vacancy rates should be going up. But the fact is, offices, a lot of them have gone bust for a start off, and a lot of them are shrinking down. So they're just making those offices smaller. The ones that do now have a hybrid workforce, some people are working from home, they don't need as much space. And the adjustment for that is just not happening right now, because the thing is, these mortgages on the buildings are so large that they don't want to readjust the values of the commercial real estate. But as soon as that happens, what happens to the loans? They're essentially a write-off. So the banks are not just looking at a residential real estate disaster here in Canada, they're also looking at a commercial real estate disaster. So, I mean, think about it. If they didn't have enough loan loss provisions for the residential part of their portfolio that is quickly falling apart, what is going to happen with the commercial part, which is 150% falling apart right now? I mean, nobody can question that. That is 100% happening. Just a disaster waiting to happen, in my opinion. And then we go down here and they've got some more interesting charts. You can see the national vacancy by segments and they break it down for you, and I'll leave a link to this. But overall, the national office vacancy rate increased to 18.1%, which is just really high. The only two markets that decreased were Calgary and Halifax, and marginally, and Calgary still has the highest vacancy rate. So even though they're like, oh yeah, things are getting slightly better in Calgary, like it decreased 1%. I mean, it is just laughable. There seems to be like some sort of drive right now by the mainstream media to kind of have Calgary on the front page of everything. It's just this place which is just booming. Just everybody move here. And I can assure you, as somebody who lives here, it's not like that at all. The people are falling for that trap, and maybe part of that trap is more political, because I think what is happening is there is being like an underlying thing to get people to move here with more liberal views, which is going to mean essentially the Conservative government in Alberta is going to be gone in the next election. And you can see how even Danielle Smith won by a much smaller margin than Jason Kenney won by in the last election. So the Conservatives are actually losing support. That's the only thing I can really put it down to, because it makes no other sense in any other way. So anyway, that's what's happening there. Really interesting. Kind of got off on a tangent there. But you can see, just look at this. Suburban and downtown office vacancy rates are climbing. We've got 31.5% of downtown offices in Calgary are empty. And if you go up the Calgary Tower on a day where the sun is in the west, you can see that. You'll see the sun shining through all the empty floors, and you'll just be like, what the hell? How is this happening? Booming in Calgary, though. I mean, it's just absolutely crazy, guys. But anyway, you can see what's happening there. You know, it's crazy. London comes in second, then Edmonton, because Alberta's economy is booming, y'all. I just love it. I just love it. Anyway, so you can see how the office vacancy rates are just crazy. And then if we go on to new construction and supply, which is basically somewhere down here, you can see that the supply is going to be going up, especially in Toronto. So look how much is under construction in Toronto right now. So under half of what's under construction is pre-lease, so that's not good. And then you can see the inventory under construction right now is actually a low point, believe it or not. And there's 11.5 million square feet of office product which remains under construction nationally, equal to 2.4% of existing inventory, of which 50% is pre-leased. So just think about that. Who finances these products? It's the big banks. It's the same big banks that are having problems with negative amortization. So the problems aren't going away for the banks. They're just getting worse and worse and worse. So we're going to continue to monitor it here and see what happens. You can probably tell by my face, I caught the sun. I was out on the bike way too long. I didn't think I'd get burnt in September. If you've enjoyed this, you might like this video here. You might like this playlist here. If you're looking for a VPN, you know where to go. Go to expressvpn.com/marketmania. You need to protect yourself against Bill C11, and you can do that with a VPN. So thanks once again for watching, and I'll see you in the next one. Take care, guys. Bye-bye.